All right, let's jump straight into this explainer. Today, we're looking at how to take $5,000 and turn it into $100,000. And we're going to do it without day trading, using a boring, almost embarrassingly simple system. Now, I know what you might be thinking. $5,000 doesn't exactly sound like a life-changing number right off the bat. For a lot of us, it's a tax refund, an annual bonus, or just that cash sitting nervously in a checking account because, honestly, we're a little too intimidated to do anything with it. But we're going to completely reframe that today. We are not talking about gambling here. No guessing on crypto, no staring at stressful stock charts with big red arrows. We are going to look at the lazy way.
Here is our quick agenda for today. We're going to break down the exact order of operations you need. We'll cover the mindset shift, meet your wealth containers, talk about surviving fees and emotions, give you a step-by-step checklist, and finish up with the power of quiet wealth.
So, Section 1, the mindset shift. We really need to start treating your money like an employee.
See, most people look at $5,000 and immediately think about what it can buy today. You know, a vacation, some car repairs, or maybe they just keep it sitting there as a safety blanket. But $5,000 isn't powerful because of what it is right now. It's powerful because of what it can become if you actually put it to work. That brings us to the difference between Mike and Rachel. Look at Mike. He really wants to invest, but he's waiting until he, quote, knows more. So the money just sits there. And sits. And over 10 years, it gets quietly eaten alive by inflation, random takeout, and Amazon orders he doesn't even remember. Now look at Rachel. She takes that same $5,000 and does something so boring it almost feels fake. She opens a Roth IRA, buys a broad, low-cost index fund, sets her dividends to reinvest, and literally walks away. No financial news channels, no panic. Just lazy consistency.
Now check out the math behind Rachel's lazy move because it is absolutely fascinating. If her money grows at a historically reasonable 8% annually, which of course isn't guaranteed but is a very standard long-term benchmark for broad stock market investing, that initial $5,000 turns into $100,000 in roughly 39 years, and she didn't add another cent. Now I can hear you thinking it. 39 years is way too long. And honestly, you're right. If your entire life plan is to invest exactly once and then disappear into the woods, yeah, it's going to take some time.
But what if you don't really want to wait 40 years? Well, adding just the equivalent of a monthly car payment completely shrinks that timeline. If Rachel takes that same $5,000 seed and just adds $200 a month to it, she crosses that $100,000 finish line in about 17 years instead of nearly 40. And think about it, $200 a month isn't some crazy billionaire number. It's just skipping a few impulse purchases, maybe taking on one side hustle client, or bypassing a couple of expensive weekends out. The real trick here is that you don't have to consciously choose to be an investor every single day. You make the choice once, you set up the automation, and you just let the math do all the heavy lifting for you.
All right, Section 2, meet your wealth containers, because the accounts matter just as much as the investments. Think of it like groceries. Buying great food doesn't matter if you leave your refrigerator unplugged, right? The container matters.
The first major container is the Roth IRA, and this one is incredible. If your 5K becomes 100K inside a Roth, you don't just make 95K. You potentially get to keep all that growth completely tax-free from the IRS in retirement. You're putting in money that you've already paid taxes on, and as long as you follow the rules, the government cannot touch the growth. For 2026, the contribution limit is $7,500 if you're under 50, which means your initial $5,000 seed fits perfectly inside it in year one.
Next up, do not ignore the 401k match. Getting 50 cents or $1 for every dollar you put in is an instant return before the market even moves. Millions of people skip this simply because retirement feels so far away. But guys, by definition, this is literally part of your salary. If you don't fill out the form, you are actively leaving your own compensation on the table. Even if the stock market goes absolutely nowhere for a year, your employer's match means you've already won. The 2026 contribution limit here is $24,500.
Then we have the HSA, the Health Savings Account. This is basically a tax cheat code. Lazy wealth builders invest the balance, pay their medical bills out of pocket, and just let the account compound for years. It's triple tax advantaged. Money goes in pre-tax, it grows tax-free, and it comes out tax-free for medical expenses. If you qualify with a high-deductible health plan, the real wealthy strategy isn't just to use it as a medical checking account, but to actually invest the funds inside it, letting them grow over decades. For 2026, the limits are $4,400 for an individual or $8,750 for a family.
So if you think of your money as the employee and the account as the workplace, you have to assign every dollar to the correct container so it doesn't underperform. An emergency fund that belongs in safe, liquid cash like a high-yield savings account, T-bills, or I-bonds, which are currently offering around 4.26%. Healthcare dollars thrive in the HSA, and your long-term wealth belongs in the Roth IRA or 401k. If you put an emergency dollar into the stock market or a retirement dollar into a basic checking account, you are putting your employee in the wrong workplace.
Moving on to Section 3, Surviving Fees and Emotions. These are the silent killers of compounding. You can have the perfect containers and the perfect mindset, but if you don't protect your money from these two threats, the math completely falls apart.
The first killer is fees. Think of fees as a leak in your boat. This is exactly why owning a broad, low-cost, total market or S&P 500 index fund is the ultimate lazy move. I mean, a 1% fee sounds polite, right? It sounds totally harmless. But over 30 or 40 years, that 1% difference between a low-cost index fund and an expensive managed fund isn't just a tiny line item. It is someone quietly siphoning off tens of thousands of dollars of your compound growth just to pay for their nice brochures. Lazy investing means stripping away those unnecessary decisions and keeping your fees as close to zero as possible.
The second silent killer is your own emotions. Compounding only works if you stop digging up the seed to see if it's a tree yet. As the saying goes, the wealthy understand volatility as the admission price, while the broke mindset sees volatility as a scam. People start a plan. The market dropped 20%, they take it weirdly personally, and they panic, pull their money out. But if you're truly investing for the long term, lower prices just mean your automated contributions are buying more shares on sale. The lazy method requires a plan that is boring enough to survive your emotions.
All right, Section 4, your step-by-step checklist. This right here is the lazy order of operations. This is exactly what you need to focus on to turn that $5,000 seed into something massive. Let's break it down.
Step 1. Establish a basic emergency buffer. You absolutely need cash on hand first so you don't have to sell your investments just to fix your car. Step 2. Contribute enough to capture the 401k match. Seriously, do not leave that salary on the table. Step 3. Look at your tax-advantaged containers, funding a Roth or traditional IRA based on your specific situation. And Step 4. Inside those containers, invest in a low-cost, diversified index fund. You really don't need to pick the winning stock, you're just buying the whole scoreboard.
Next up, the final steps. Step 5 is the glue holding this all together. Automate a monthly transfer amount. Whether it's $50 or $500, make it automatic. Step 6, guarantee your wealth scales with your career by increasing that amount when your income rises before lifestyle inflation eats your raises. And finally, Step 7, just leave it alone. I know leaving it alone feels wrong because we are taught that hard work requires constant action. But in finance, discipline in action is usually the absolute most productive thing you can do.
I really want to focus on Step 5 for a second, because letting automation win is vital. Let's be real, your mood is terrible with money. You bypass your sudden desire for iced coffee and online shopping by letting your bank handle the automated investment transfers. If you have to actively decide to invest every single month, you will eventually find an excuse not to. You'll be tired, you'll be stressed, and emotionally supportive online shopping will inevitably win. The lazy method works because the math does not need your personality to be exciting. Just let automation win.
Finally, Section 5, the power of quiet wealth. Boring decisions, brilliant balance sheets. Bringing it all home, let's redefine what being rich actually looks like today, because it usually isn't a rented Lamborghini on social media. We are constantly sold this vision of wealth that is loud, fast, and incredibly stressful. But the math of turning $5,000 into a fortune, it tells a completely different story.
Quiet wealth is a series of boring, disciplined systems that protect your money from your own impulses and allow time to do the heavy lifting. This is what true financial momentum actually looks like. It's automatic transfers firing off every month in the background. It's a Roth IRA you barely even mention. It's capturing that 401k match relentlessly every single paycheck. It's an HSA that's invested instead of forgotten. It's sticking to low-cost funds and looking at boring statements. Mostly, it means you stop needing every single dollar in your bank account to entertain you today. It might look stupid on social media, but I promise you it looks brilliant on a balance sheet. You know, the second best time to plant your seed isn't after watching 17 more explainers. It's right now. So what are you going to do with your first $5,000? Stop looking at it as just a tiny amount of money. Start looking at it as a seed that just needs the right soil, a little bit of protection, and the time to grow. Use the containers, set up that automation checklist, and let the lazy method do the rest. What will your seed become?